Welcome to Breaking News to Trading Moves.
It's good to be here.
Today we are focused on a single piece of news. But it's one of those pieces that, it really helps illuminate how capital is flowing across an entire ecosystem.
That's a perfect way to put it. We're looking at the whole food supply chain today, and our lens for this is a company called Neogen.
Neogen, that's ticker NEOG.
Correct. They're a key player in the food and animal safety testing industry. And the reason we're talking about them is that they recently released an earnings report that was, it was much stronger than analysts have been predicting.
And you could really see the market react to this, right away.
Oh, absolutely. The stock, NEOG, it just took off. We saw a sharp upward movement. I think it was a 20% surge in the stock price almost immediately.
So our job today is to move beyond just that initial headline pop. We want to look at the momentum that followed.
Exactly. It's about following the capital. When a company like Neogen posts these kinds of results, the market starts to reprice everything around it. The risk, the opportunity in adjacent sectors.
So we're going to identify the companies that are catching a tailwind from this.
Right. The ones where the Neogen results kind of validate their business model. And on the flip side, we have to look at the sectors that are now facing some pressure.
And because of what this implies, right?
Yeah.
Higher compliance standards, maybe higher costs.
Precisely. More pressure on their cost structures all the way through the supply network.
Okay, so let's start at the very beginning. What was the Neogen catalyst? What did Neogen, that's NEOG, specifically announce that triggered such a fast reevaluation?
So at its core, Neogen is a food safety and animal safety testing company. They make and sell these diagnostic test kits, chemical reagents, and the instruments that go with them.
And these are used to detect things like
What?
pathogens, toxins.
Pathogens, toxins, allergens, animal diseases, pretty much anything you don't want in the food supply. And the positive movement in the stock was driven by two key elements in their announcement. They really reinforced each other.
Okay, so what was the first element? Was it just past performance?
It was. They reported a much stronger than expected fiscal quarter. They just executed really well, beat what Wall Street was accepting on revenue, the top line, and also on key profitability metrics.
Which shows good internal efficiency.
It does. It tells the market that the demand they're serving is picking up, or at the very least, that the business is recovering from any, prior slowdowns much faster than anyone thought.
And then there's the second element. And from our experience, this is the one that often influences trading strategies a lot more than historical data.
That's the forward-looking element. Neogen raised its full-year outlook.
They lifted their guidance.
Yes, and that's the piece that really validates a sustained trajectory. It's a huge signal of confidence from the management team.
You're essentially telling the market this wasn't just a fluke quarter.
Exactly. They're saying the improved execution and the strong demand aren't some temporary spike, maybe from inventory cycling or a seasonal thing. They're saying it's structural, and they expect it to hold for the rest of the fiscal year. It confirms a longer-term trend.
Let's talk a little bit about the mechanics of that market reaction, because a 20% jump is not typical, even for a strong quarter. The fact that one company in this, pretty specific niche can move the needle so much for the whole ecosystem, it suggests there were some preconditions there.
It really does. It highlights the kind of volatility and, I'd say, the inherent sensitivity of the small to mid-capitalization life science tools sector.
Right. These aren't the mega-cap tech companies.
Not at all. These companies often have smaller floats, which just means fewer shares are available to be traded actively, and they're typically covered by a smaller group of analysts compared to, say, a giant pharmaceutical company.
So what happens when a piece of unexpectedly good news, like this Neogen report, hits a stock like that?
Well, when an earnings beat like this happens in that kind of environment, it immediately attracts what we call momentum flows. Investors who were maybe skeptical before or were underweight the stock or even the whole sector,
They all rush in at once.
they scramble to adjust their positions. And because the liquidity is lower, that sudden rush of buying volume can cause the stock price to move very, very quickly. That's how you get a 20% surge. It suggests the market was really underestimating the health of this sector right before the announcement.
And this momentum buying, it feels especially relevant when you think about that raised guidance piece. Can you help the listener understand why that future promise so often outweighs the past results when it comes to a stock's valuation?
Sure. Think about it this way. The quarterly results, they're fixed. It's historical data. It tells you what happened in the last 3 months.
In the rearview mirror.
Exactly. But when a management team raises guidance, they are changing the entire model that analysts use to figure out what the stock is worth. the discounted cash flow model. It's a public commitment. The company's saying they believe they can accelerate their growth, whether that's through better pricing power, better execution, or just a major increase in the underlying market demand.
So it's not just a win for Neogen. It validates the whole investment thesis for the entire testing industry, in a way.
Precisely. The thinking goes, if Neogen, NEOG, is confidently raising its forecast, it suggests they are seeing sustainable growth drivers across the entire food safety landscape.
Okay, so let's connect that to the broader industry logic, the testing and diagnostics sector as a whole. What is the implication that the market is drawing from Neogen's performance here?
The underlying logic is pretty straightforward. If Neogen can show that demand for these essential testing services is stabilizing, or even better, accelerating, and if they can show that their margins are expanding through internal efficiencies.
Like better cost management or maybe integrating an acquisition well?
Right. If they can do both of those things, then it means the industry headwinds that people were worried about, maybe things related to pandemic demand volatility or inflationary pressures, it means those headwinds are easing.
So the market is looking at Neogen's internal success and using it as a proxy for the health of the whole compliance ecosystem.
Absolutely. And this just reinforces the basic conviction that underpins any investment in this sector. That food safety and animal health are tied to these long-term must-spend trends.
This isn't discretionary spending.
Not at all. It's insulated from the immediate ups and downs of the economic cycle because the drivers are things like regulation, public health concerns, and a company's reputation.
Let's maybe get a little deeper into why that spending is truly non-negotiable for these companies, for the food producers and retailers.
Well, think about the regulatory environment first. Governments, here and abroad, are constantly moving towards stricter standards for food quality and safety. Compliance is not optional. It is the cost of doing business.
And the cost of failure is astronomical.
Catastrophic. If a food processor fails a pathogen detection audit, you're looking at massive recalls, potential legal liability, and just instant, maybe irreparable damage to your brand's reputation.
Can you give us some specific areas within that must-spend category? What are the things that keep these testing companies busy no matter what?
Certainly. There are, I'd say, 3 consistent areas of demand that are always there, regardless of the consumer spending environment. First is pathogen detection.
The basics.
The absolute basics, the ongoing fight against things like salmonella, E. coli, listeria. You cannot skip testing for these. Second, you have government compliance requirements. As standards evolve, new tests and more frequent testing are mandated by law.
And a third one.
The third, and this is becoming more and more critical, is traceability capabilities. The ability to track every single component of a food product from its source all the way to the grocery store shelf. These 3 requirements act as a floor on spending. They don't really fluctuate with the price of beef or milk.
That's a crucial distinction. It's not really about how much food is being sold, but it's about the quality assurance that's needed for every single unit that is sold.
Precisely. The nature of the food supply chain is that a failure in just one part of it has immediate high-consequence fallout for the entire system. So the investment in a robust testing infrastructure, all the tools and diagnostics, it's essentially insurance for the rest of the industry. And that makes the companies that provide those tools highly resilient businesses.
That context gives us a really solid foundation for understanding the momentum flow here. We've established Neogen's guidance, validated the stickiness of this compliance spending. So now let's get into the trading moves that followed, starting with the companies that operate in the most validated segments.
We can start with the most direct beneficiaries. These are the companies involved in food safety testing, pathogen detection, and lab instruments. Neogen's success is seen as confirmation that capital expenditure on testing infrastructure is strong.
The market thesis is pretty clear then. If Neogen, NEGE, is selling more test kits and executing well, it must mean that the need for all compliance tools is growing across the board.
Yes, and that growth isn't just in the test kits, which is Neogen's specialty. It actually extends to the entire business-to-business workflow. We're talking about sophisticated lab instruments, chemical reagents, and the complete integrated lab workflows that are sold to major food producers and the big independent testing labs. The whole ecosystem relies on this hierarchy of technology.
So the consensus is, if the smaller and mid-cap players are thriving, then the big large-cap companies that supply the underlying technology must also be seeing a wave of increased spending.
That is the core read-through. The Neogen results suggest that food processors and their QA departments are signing off on investments in more advanced, higher throughput equipment. And these investments are driven by 2 factors. One, the need for faster results to prevent costly product hold times, and two, the ability to detect increasingly complex or novel pathogens.
I have a question here, though, for the listener. If this regulatory pressure is so constant, why wasn't this already anticipated? Why the sudden surge right after Neogen reported?
That's a sharp question. The anticipation for the need was there, but the execution was the variable. A lot of investors were worried that things like inflationary pressures and labor shortages would force food processors to defer their capital spending, or that Neogen, NEOG, and its peers would struggle to expand their own margins because of their own supply chain and labor costs.
And Neogen's results proved that bear case wrong.
Exactly. It countered that argument by demonstrating both robust demand and successful margin expansion. So the news didn't just confirm the trend, it confirmed the sector's profitability within that trend.
Excellent. That brings us to the specific names that are benefiting from this confirmed spending cycle, and we have to start with the infrastructure giants.
Yes, we look immediately at a company like Thermo Fisher, that's ticker TMO. They are a behemoth in the laboratory space. They supply everything: instruments, services, consumables, reagents. When stricter industry safety standards are adopted, it requires specialized, often high-precision equipment upgrades.
So what specific types of lab equipment sold by Thermo Fisher, TMO, would suddenly be in higher demand because of this?
We are talking about really critical analytical tools. For example, high-volume mass spectrometers. Those are used for detecting tiny levels of chemical contaminants, or advanced PCR, polymerase chain reaction, thermal cyclers, which are used for rapid, high-sensitivity pathogen identification.
These are the backbones of a modern food safety lab.
They are. And increased capital spending in these lab workflows, which is fueled by the heightened compliance needs, translates directly into sales of these large-ticket items for a company like Thermo Fisher.
Okay, so if TMO provides that broad laboratory infrastructure, where does a company like Danaher, ticker DHR, fit into this momentum flow?
Danaher, DHR, is another key supplier of advanced diagnostics and life science tools, but they often specialize in more high-end, precise workflows. So while Thermo Fisher, TMO, provides a very wide array of tools, Danaher, DHR, tends to focus on integrated, cutting-edge diagnostic platforms.
How does that distinction play out in a food testing lab setting? What's the practical difference?
Well, when food safety is the top priority, high throughput is absolutely essential. Danaher, DHR, sells systems that allow for faster, more accurate genetic sequencing. This is crucial for rapid outbreak management.
So instead of waiting days for an old-school culture result.
Exactly. Instead of waiting days, labs can use these advanced genomic tools to identify the exact strain of a pathogen in a matter of hours. So as the pressure on testing standards becomes more acute, the demand for Danaher's sophisticated diagnostic platforms increases because they offer higher throughput and greater precision than the standard screening methods. They kind of fill the gap between a positive screening test and the deep validation you need for regulatory reporting.
So it sounds like Neogen, NEOG, confirms the necessity of the fight, and then companies like Thermo Fisher, TMO, and Danaher, DHR, are providing the heavy artillery for that fight.
That's a concise analogy. The volume of tests goes up, driving demand for Neogen's consumables. Then the complexity of the tests goes up, driving demand for TMO and DHR's expensive, high-margin instruments.
Okay, so moving beyond the processing lab itself, our next area of momentum is veterinary diagnostics and animal health biosecurity. How does Neogen's NEOG's food safety win immediately extend to these animal health companies?
This is all about recognizing how interconnected the supply chain is. You can have the most robust food safety at the processing plant, but it's only as strong as the biosecurity at the source, at the farm, or the ranch. Industry operators understand that the most effective way to prevent a costly pathogen contamination is to stop it before it even enters the processing facility.
So a heightened focus on food safety downstream acts as an upstream mandate for better testing discipline on the animal side.
Exactly. The market implication is that if food processors are spending more on pathogen testing, they will inevitably pass this cost and, more importantly, this risk back onto their suppliers. This pressure reinforces the sustained demand for veterinary diagnostics and animal health biosecurity products across the entire animal ecosystem, and that includes aquaculture and poultry too.
This really sounds like a structural change, where spending on animal health moves from being seen as just a veterinary expense to becoming an essential part of the overall corporate food safety and risk management budget.
That's the key distinction. It ensures there's consistent capital allocation to prevention and diagnostics. If a major meat packer faces a costly recall, You can be sure they will demand that their partner farms implement advanced mandatory biosecurity protocols, which very often means sophisticated diagnostic testing.
Okay, let's talk about the specific players who benefit here. We can start with IDXX Laboratories. That's ticker IDXX. They're a leader in veterinary diagnostics.
IDESX Laboratories, IDESX, is perfectly positioned for this.
Huh.
While they're well known for companion animal, pet diagnostics, they also have very strong segments in livestock testing and, importantly, water testing.
And water quality is crucial.
Absolutely crucial in both animal husbandry and processing. Their diagnostics are instrumental in identifying and managing animal diseases, everything from common infections to zoonotic pathogens, before they can escalate into systemic issues that would contaminate the food chain. So this increased focus on biosecurity directly and structurally benefits their core business lines.
And we also see major pharmaceutical names in animal health on this list, like Zoetis, ticker ZTS.
Yes, Zoetis ZTS is a major global player. They focus on animal medicines and vaccines, and their role shifts a little bit in this heightened environment. When the industry prioritizes biosecurity, it's not just about diagnosing diseases after they appear, it's about preventing them in the first place.
So how does that shift impact Zoetis ZTS specifically?
It increases the demand for their preventative solutions. This includes advanced vaccines designed to protect large animal populations from common diseases. These can be expensive, but they're viewed as a necessary defense against a systemic risk. What's more, Zoetis ZTS provides consulting and data services related to herd health and surveillance, which ties directly into these enhanced biosecurity mandates. The market recognizes that Zoetis' focus on long-term animal health management aligns perfectly with the processor's need to minimize risk at the farm gate.
And similarly, I assume Elanco Animal Health, ticker ELAN, benefits from the same dynamic.
Elanco Animal Health, Elon, is another key name in this space, and yes, they do. They benefit from operators viewing this testing discipline as a critical operational cost, not a discretionary one. This movement makes the spending on their products, whether it's pharmaceuticals, nutritional products, or diagnostics, a required element of regulatory compliance. As food producers prioritize the integrity of their supply chain, the demand for high-quality, reliable animal health interventions from a company like Elanco Elon becomes firmer and much less susceptible to cost-cutting pressures.
This flow from the lab, so TMO and DHR, to the farm with IDXX and ZTS, it paints a very comprehensive picture. But none of this works if you can't track the product itself. So our third category of winners moves to the operational level: traceability, labeling, and automation enablers.
You've hit on the operational pull-through. When safety standards are heightened, just getting a test result isn't enough. Regulators and, frankly, consumers demand immediate transparency. They demand the ability to trace a contaminated product right back to its precise source, the specific batch, the date, the location.
And making that happen requires really robust systems for execution.
Exactly. This translates directly into increased mandatory demand for specialized tracking, standardized labeling, and high-speed data capture across these complex, often fragmented supply chains. If a pathogen is found, the margin for error in traceability is effectively zero.
This is where automation becomes essential, right? You can't just layer on all these new stringent safety and audit requirements demanding data points within minutes and expect human beings to manage that scale manually.
Automated solutions are the only way to operationalize these new levels of safety standards efficiently and accurately. Just consider the sheer volume of products moving through a modern processing plant or a distribution center. If every pallet or even every major component requires specific traceability data linked via a unique identifier, manual input is it's infeasible, it's slow, and it's prone to massive error. You need sophisticated technology to handle the volume and velocity of that data.
Let's look at the critical players in this area, starting with Avery Dennison, ticker AVIY, which handles the labeling side of this equation.
Avery Dennison, AVY, is a massive supplier of labeling and materials science solutions. Now, this might sound a bit mundane, but accurate, durable, and specialized labeling is absolutely critical for tracking goods, especially in demanding environments like cold storage, high moisture, or varying temperatures.
So they're providing the physical high-tech label.
Right. Often it's RFID enabled or it's a specialized durable barcode, and that label allows the data capture systems to function flawlessly throughout the entire logistical chain. The growth in mandatory specialized labeling standards directly increases their sales of these materials.
So the label is the physical key, but then you have a company like Zebra Technologies, ticker ZBRA, that provides the system to read that key and manage the data.
Zebra Technologies, ZBRA, is the infrastructure provider in this space. They specialize in the tracking technologies. The industrial-grade mobile computers, the scanners, the printers, and the barcode systems that are all optimized for warehouse and supply chain environments. These tools are essential for real-time supply chain visibility. If a regulator demands to know the exact source of an issue within minutes, it's Zebra's infrastructure that ensures that instantaneous, accurate data flow from the time a raw material is received to when the final package leaves the dock.
So to tie it all together, Neogen's success in testing confirms the long-term need for compliance, which then triggers immediate spending on the execution side. The labeling and tracking infrastructure provided by Avery Dennison, AVY, and Zebra Technologies, ZBRA.
It creates a powerful investment cycle. The more stringent the testing, the more critical the need for a non-corruptible audit trail, and that trail is built on AVY's materials and ZBRA's technology. The market is recognizing this immediate pull-through demand.
We've established a very clear picture of the gainers, the companies selling the tools, the technology, the diagnostic platforms that benefit from this mandatory spending. However, the costs that are incurred by this compliance ecosystem, they have to be paid for by someone. This brings us to the flip side, the companies that face immediate pressure.
That's right. While the tool providers benefit from these must-spend dynamics, the businesses that consume those services and tools and are often structured with very tight operating margins, they feel the cost squeeze instantly. Tighter safety standards dramatically increase the cost of doing business, but they don't necessarily provide a commensurate increase in revenue.
Let's transition now to the sectors facing that pressure. Our first category here is packaged food and meat producers, the ones with high volume operations and high margin sensitivity.
The central challenge for these companies is the inherent structure of their business. They rely on massive volume and extreme operational efficiency just to maintain profitability. Their operating margins are often wafer-thin, sometimes in the low single digits, because of intense competition and the volatility in commodity prices like grain, feed, and livestock.
And how does the Neogen NEOG news, which implies higher standards across the board, translate into acute pressure for these producers?
The market's interpretation is that more stringent quality assurance, or QA requirements, are now unavoidable and are likely to increase in both frequency and complexity. This means mandatory higher operating costs. These companies must either massively expand their in-house labs, which is an expensive capital expenditure, or they have to outsource more testing to third-party labs, which is an expensive operational expenditure.
The crucial question here is their inability to pass those costs on immediately. I mean, why can't a company like Tyson or Hormel just charge retailers 2% more to cover this new QA expense?
Because of consumer price elasticity and intense competition, particularly from private labels, if a branded producer raises the price of its bacon or its frozen dinners by even a few percent, consumers often just pivot to the cheaper store brand or a competitive generic product. In the current retail environment, absorbing those fixed compliance costs is very difficult without sacrificing market share or profitability. The additional compliance expense hits their gross margin directly and hard.
Let's use Tyson Foods, ticker TSN, as our first example. They are a massive meat producer known for their vertical integration.
Tyson Foods, TSN, operates across the entire chain from farming all the way to processing and packaging. And their vertical integration, which usually provides them with cost control benefits, can actually become a liability when QA standards rise dramatically. They end up owning the problem from the very earliest stage. Because the cost increase from this rigorous, non-negotiable pathogen testing is multiplied across every single stage of their vast processing operations. If the required frequency of testing doubles at the processing plant, that cost is spread across millions of units of meat, creating a direct, measurable squeeze on their margin per unit. They can't simply push the entire cost back upstream to an independent supplier because in many cases, they are their own supplier.
And I imagine the same cost pressure applies to branded package producers like Hormel Foods, HRL.
It does. Hormel Foods, HRL, manages complex supply chains for highly branded products, from canned meat to snacks. Maintaining their brand reputation is paramount, which means they have to spend whatever is necessary on QA to ensure compliance. If industry-wide standards for ingredients or processing are elevated, that increased QA spend hits their profit margins directly. Even with their brand loyalty, they cannot fully escape the commodity cost pressures of raw materials, and now they have this added, sticky, fixed cost in QA.
And finally, Conagra Brands, ticker CAG, another large packaged food company operating across numerous categories.
Conagra Brands, CAG, faces the challenge of managing margin preservation across a very diverse portfolio that includes everything from frozen foods to shelf-stable ingredients. For a company of this scale, implementing new, faster, more frequent testing protocols across their entire system for every raw material input, every facility, and every finished product batch is a major system-wide operating expense. In a market that's focused on efficiency and cost savings, this new mandate really challenges their ability to meet their existing profitability targets.
That sets the stage for the producers. Now, moving on to our second category of companies facing pressure. Food service and restaurants exposed to safety headlines and rising input costs. These companies face a genuine dual threat.
They are really caught in the middle. They don't get the benefit of selling the testing tools, and they have no choice but to consume the services and products that are derived from these newly tightened standards.
Let's break down that first pressure point, the input costs.
The producers we just talked about, the processors and packaged food suppliers, they will attempt to pass along their increased quality assurance and testing costs. And the restaurants, which rely on these suppliers for meat, produce, and packaged ingredients, they see their cost of goods sold rise. If food costs go up by even 1%, that can wipe out a large portion of a restaurant's operating profit, given their already tight margins.
But the more existential threat, particularly in this sector, is the direct reputational risk.
Absolutely. The reputational risk is compounded by the input cost pressure. If food safety scrutiny increases across the board, consumers become more aware and regulators are more vigilant. If an incident occurs, even if it originated with a supplier, the restaurant is the one that carries the direct reputational damage. This risk immediately impacts customer traffic and sales, and that can destroy value far faster than a slow erosion of margin.
We have some stark historical examples here, starting with Chipotle, ticker CMG.
Chipotle, CMG, is the perfect case study in reputational sensitivity. They've experienced food safety issues in the past that severely impacted their business model and their stock price, and it forced them into a long, expensive recovery phase based on proving their commitment to safety.
And this translates into continuous high capital investment in traceability and QA systems for them.
Yes, they have to spend far above the industry average just to manage that perpetual reputational risk and maintain consumer trust. The implied rising industry standards from the Neogen report just reinforce the market's view that these costs for Chipotle are sticky, they're mandatory, and they're likely to climb, placing continuous pressure on their profitability expectations.
Then we can consider the global scale players like Yum Brands, ticker YUM.
Yum. Brands, YUM, which manages global fast food chains like KFC, Pizza Hut, and Taco Bell, faces exposure tied to global supply chain integrity. They operate across dozens of countries, many with varying regulatory and logistical standards. A heightened global focus on compliance means they have to implement massive centralized QA investment just to ensure consistency across their enormous network. The complexity costs increase exponentially with every new mandated safety protocol.
And McDonald's, ticker MCD, the gold standard in standardization.
McDonald's, MCD, requires massive, uniformly standardized quality assurance across a truly global network of suppliers and franchise locations. When compliance standards rise, for instance, requiring a specific type of rapid pathogen test, the cost of implementing that elevated standard uniformly across their entire ecosystem is huge. Every additional required test or audit has to be integrated into thousands of supplier relationships worldwide, which makes them highly susceptible to cost creep from these compliance mandates.
Our final pressure point lands on the entities that are responsible for that last mile of logistics. Grocery and distribution that must operationalize traceability at scale. This is where the sheer burden of data integration becomes the primary cost.
This is often the choke point in the system. The expectation for seamless end-to-end traceability from the farm to the processor to the distributor to the retail shelf, it ultimately lands squarely on the shoulders of the distributors and the grocers. They are the ones who have to integrate and manage the vast amounts of new data generated by all compliance efforts we've discussed.
So it's not just about moving boxes anymore. It's about managing the digital footprint of the contents inside those boxes.
Precisely. And this creates a major cost impact. Distributors and grocers frequently end up funding these system upgrades themselves because their upstream suppliers, especially smaller ones, often lack the technology to meet the new traceability standards. This includes procuring new specialized labeling systems, meeting stricter audit requirements, and completely overhauling their existing data architecture to securely capture, store, and process all of this new traceability information.
And the pressure immediately impacts near-term operating costs because this spending is largely administrative and technological. It's not really margin generating.
It is the operational burden. Let's look at Cisco, ticker SYY, a major food distributor that services food service clients. Cisco, SYY, manages incredibly complex logistics. If the upstream standards now require granular data like timestamps, temperature logs, and specific batch identifiers, for every single product, Cisco, SYY, has to implement the technology, the IT infrastructure, and the training to manage that massive data stream efficiently for every product that enters and leaves their warehouses. This investment in logistics IT and QA processes is a compulsory, expensive upgrade.
And large grocery retailers like Kroger, ticker KR.
Kroger, KR, operates right at the nexus of the supply chain and the consumer. They are responsible for implementing traceability systems that span from their receiving dock all the way to the consumer's final receipt. This requires them not only to manage the data supplied by their vast network of vendors, but also to often institute their own rigorous internal audit systems and shelf life tracking based on this enhanced safety data. They bear the massive cost of system integration across a vast, decentralized retail footprint.
And finally, United Natural Foods, ticker UNFI, which specializes in a particularly sensitive area of distribution.
United Natural Foods, UNFI, specializes in distributing natural and organic foods. These specialized supply chains often rely on smaller, less technologically sophisticated producers, and that makes the data integration challenge even harder for them. Furthermore, organic and natural food consumers often have elevated expectations for transparency. When overall safety scrutiny rises, the pressure on specialized distributors like UNFI to maintain exceptionally high levels of data integrity and traceability becomes particularly acute, demanding expensive, tailored data system solutions that may not easily scale across their smaller vendor base.
This has been a really comprehensive analysis of the chain reaction following a single, powerful earnings report. Neogen, NEOG, delivered strong results, and the market immediately used that data point as a lens to assess the entire food safety compliance ecosystem.
The dynamic is clear. The long-term, non-discretionary focus on compliance is fueling capital expenditure and operational spending. The companies that sell the tools, the technology, and the diagnostic platforms, the enablers, they stand to benefit.
Meanwhile, the companies that consume those services, the processors, the restaurants, and the grocers, they're facing immediate cost headwinds. It's because of their margin sensitivity and the immense operational complexity that's required to implement these high standards at scale. The cost of food safety compliance is ratcheting upwards, and it appears to be sticky.
The central takeaway for you, the listener, is that understanding these regulatory capital flows is key to navigating the supply chain market. For every unit of revenue generated by the testing providers, there is a subsequent and sometimes larger cost burden placed upon the operators downstream who have to implement all the traceability and tracking mandates.
That structural reality leads us to our final thought for today. Given this rising emphasis on traceability, on data capture, and the high compliance and data system costs that are being faced by distributors and grocers companies like Cisco, SYY, and Kroger, KR, how long will it be until these mounting operational costs start influencing their strategic sourcing decisions? Will they begin to systematically favor or prioritize suppliers who already have the most technologically advanced and transparent tracking systems, and in doing so, potentially consolidate shelf space and supplier relationships away from the smaller, less digitized vendors?
That is the ultimate question of competitive advantage in a high-compliance world.
Thank you for tuning in to Breaking News to Trading Moves.
We appreciate you joining us for this analysis of market momentum.
Disclaimer. This information is purely the opinion of the author and should not be construed as financial advice or recommendations to buy or sell any security.